Think about this for a moment. For 40 years, you did exactly what you were supposed to do. You woke up early, you showed up to work, and you saved every extra dollar you could find. Your entire adult life revolved around building wealth and protecting that nest egg. Then retirement finally arrives, and suddenly, you are expected to flip a switch. You are supposed to stop saving and start spending the very money you spent decades carefully protecting. That is terrifying, is it not? For so many people, this massive life transition triggers a very real scarcity mindset. We become genuinely afraid of running out of money. And because of that fear, when the time comes to decide how to pay ourselves in retirement, we fall back on instinct. And that instinct tells us to play it safe. This is a plan heard from retirees almost every single day. They say, I am going to claim my Social Security as early as possible, at age 62. I will combine that with my monthly pension check to cover my bills, and my 401k, I am not going to touch it. I will leave that money locked away, safe and sound, for a rainy day. It sounds completely logical. It feels like the safest way to guarantee you will never go broke. That reaction is completely understandable. But here is the hard truth. Following that gut instinct is one of the biggest retirement mistakes you can make. In fact, doing it in that order is precisely what the IRS is hoping you will do. Why? Because hoarding your 401k while claiming Social Security early is a massive trap. It guarantees you a much smaller lifetime income, and it sets you up for enormous forced tax bills later in retirement. You are accidentally volunteering to hand a huge portion of your hard-earned money right back to the government. Today, we are talking about the withdrawal order most retirees get completely backward. By the end of this, you will understand exactly how to flip this strategy around, how to protect your nest egg, maximize your monthly income, and keep the IRS out of your pockets. To make sense of how to pay yourself in retirement, we need to stop overcomplicating things. Imagine you have 3 distinct buckets of money sitting on your kitchen table. Each bucket holds your hard-earned cash, but the IRS treats the money inside each one very differently. Understanding the specific rules for these 3 buckets is the absolute key to keeping more of your own money. If you are fortunate enough to have earned a traditional pension from your employer, think of it as your solid financial foundation. A pension is excellent because it provides a guaranteed monthly check you can count on without fail. However, it is also very inflexible. Once you officially retire and tell your employer to flip the switch, the money simply starts flowing. You cannot speed it up or slow it down to manage your taxes in a given year. Here is the critical detail you must remember about your pension bucket. Every single dollar that comes out of it is taxed by the IRS as ordinary income. There is no hiding it, and there are no special tax breaks attached to it. Whatever your regular income tax bracket happens to be, that retirement account rules were recently updated under a federal law called the Secure 2.0 Act. Under current United States tax law, when you turn 73, the IRS steps in and declares that time is up. They issue what is called a required minimum distribution, commonly referred to as an RMD. In plain terms, an RMD means the federal government forces you to withdraw a specific calculated amount from your 401k every single year, and you must pay regular income taxes on every dollar of it. It does not matter whether you actually need the money for groceries or whether you already have plenty sitting in the bank. The IRS allowed you to defer taxes for decades, but at age 73, they are done waiting. If you miss an RMD or refuse to take it, the IRS imposes a 25% excise tax penalty on the amount you were supposed to withdraw, on top of the regular income taxes owed. It is one of the harshest penalties in the entire federal tax code. This obligation cannot be ignored. Now let us look at the full damage John created for himself by waiting. He ignored his 401k from age 62 all the way to age 73, 11 solid years. Over that time, his account grew and compounded untouched. His balance ballooned to nearly $900,000. It's exactly the rate you are paying on every dollar of your pension. This is the flex bucket because you have total control over exactly when you choose to open it. The federal government allows you to start collecting as early as age 62. You can wait until your full retirement age, which for most people retiring today falls somewhere around age 66 or 67. Or you can choose to delay all the way until age 70. Here is the golden rule for this bucket. Every single year you wait to claim Social Security past your full retirement age, your monthly benefit grows by a guaranteed 8%. Let that sink in. A guaranteed 8% return. There is not a single stock market investment, real estate deal, or savings account anywhere that can promise you a completely risk-free 8% return year after year. Waiting to open this bucket is one of the most powerful tools available for your long-term financial security. For most retirees, this is the largest bucket of all. You spent decades feeding it. But it is important to change how you look at it. Do not look at it purely as wealth. Think of this bucket as a ticking tax clock. Why? Because the money sitting inside it has never been taxed. All those years you were working and contributing a portion of your paycheck, the government gave you an upfront tax break. The money grew completely tax-deferred. But the IRS never forgot about it. You essentially hold a massive IOU with the United States government. They allowed your money to grow tax-deferred for decades, but eventually they absolutely demand their share, and they will not wait forever. The IRS has strict rules about when you must begin withdrawing from this bucket, whether you want the money or not. Let us put all of this together and look at exactly how this common mistake unfolds. Consider a hardworking retiree. For our purposes today, we will call him John. John decides to officially retire at age 62. Like many people, he is terrified of running out of money. So he does what feels like the safest possible thing. He immediately turns on his company pension to get reliable monthly cash flowing. Next, he claims his Social Security right away at 62. He knows he is accepting a permanently reduced monthly check by claiming early, but he wants that security. And his 401k? John decides he will not touch a single dollar of it. He locks it away as his ultimate emergency fund, convinced he is preserving his wealth for later years. For an entire decade, John feels pretty good about his plan. He is living modestly off his pension and early Social Security, and his 401k balance quietly grows larger in the background. But then, John celebrates his 73rd birthday. This is the exact moment the trap he accidentally set for himself finally snaps shut. On paper, that sounds wonderful, but it is not wonderful to the IRS. Because his account balance is now so large, his forced required minimum distribution is enormous. The government calculates the withdrawal based on his account balance and IRS life expectancy tables and forces him to pull out over $30,000 that year and every year after that, whether he wants to or not. Now consider the situation John is in. He already has his pension flowing out taxable income every month. He has his Social Security flowing. And now, at 73, the government essentially backs up a financial dump truck and unloads this massive forced 401k withdrawal on top of everything else. This is what financial planners call the tax torpedo. All at once, John's annual income spikes dramatically. This stacked income pushes him into a far higher tax bracket than he ever anticipated in retirement. But it gets worse. Because his income suddenly looks so high, it triggers another hidden consequence. Under existing IRS rules, up to 85% of his Social Security benefits become fully taxable. Consider what that means. John lived carefully and frugally through his 60s. He accepted a smaller Social Security check. He hoarded his life savings out of fear. And his reward for all that sacrifice is that he now hands a massive portion of his own money back to the federal government. He lost complete control of his own tax situation. Now let us take a breath and completely flip the script. What comes next may feel entirely wrong at first. Here it is. Spend your 401k money first. Instead of locking it away like a precious treasure, deliberately spend it down during the early years of your retirement. This goes against every instinct built up over 40 years of working and saving. But mathematically and practically, this counterintuitive approach is the smartest way to protect your wealth from the IRS. This is called the 401k bridge strategy, and it works in 2 straightforward steps. Step 1 is to turn on your pension, if you have one. When you retire at 62, flip the switch on that guaranteed pension income. Use it as your reliable baseline, the money that keeps the lights on, covers property taxes, and handles basic living expenses. Knowing that check arrives every month gives you the stability to execute the rest of the plan. Step 2 is where you build the actual bridge. Between the day you retire at 62 and the day you turn 70, you will intentionally draw from your 401k to fund the rest of your lifestyle: vacations, hobbies, home repairs, and everyday comforts. Think of these 8 years as a wide river you have to cross. Your 401k is the sturdy bridge that gets you safely from age 62 to age 70 without ever touching your Social Security at all. By using your 401k to cover expenses during your 60s, you are buying your Social Security benefit the time it needs to grow. Remember the golden rule. Every year you wait past your full retirement age, the government increases your monthly check by a guaranteed 8%. By waiting until age 70 to claim it, you lock in the highest possible monthly payment for the rest of your life, a guaranteed, inflation-adjusted check that will never run out, no matter how long you live. By deliberately spending down your 401k during your 60s, you are actively draining that taxable bucket before the IRS gets involved. You are intentionally making the balance smaller. Why does that matter? Because when you turn 73 and the government demands those required minimum distributions, the account balance they calculate from is vastly smaller. A smaller balance means a dramatically lower forced withdrawal. You have effectively eliminated the tax torpedo before it ever had a chance to launch. When you retire in your early 60s and have not yet claimed Social Security, your taxable income is naturally much lower. Only your pension is showing on your tax return. That means you have significant room in the lowest federal tax brackets. You get to operate on your own terms. You can intentionally withdraw just enough from your 401k each year to fill those cheaper, lower brackets without spilling over into the more expensive ones. You control how much tax you pay each year. You are systematically moving money out of a heavily taxed environment and into your own pocket at a significant discount. Contrast that with the backward approach. If you wait until 73, you have zero control. The IRS looks at your 401k balance, applies the life expectancy tables, and tells you exactly how much you must withdraw, regardless of what it does to your tax bracket. They force you to stack it on top of your Social Security and pension, pushing you into the highest possible tax rates. The bridge strategy puts the steering wheel back in your hands. You are choosing to pay taxes now while rates are effectively on sale, rather than being forced to pay a premium later when the government dictates the terms. Writing that first withdrawal check from your 401k will feel uncomfortable. You have spent your entire working life putting money in, never taking it out. But here is the important reframe. The money in that account was never entirely yours to begin with. The government has always owned a percentage of it. By spending it down carefully during your 60s, you are simply paying that obligation on your own schedule, proactively rather than reactively. Let us bring this concept to life with two neighbors. We will call them Hoarder Harry and Strategic Sally. Both Harry and Sally are turning 62 this year. They have identical financial profiles: 401k balance, $500,000, monthly company pension, $2,000, Social Security at full retirement age, $2,500 per month. They are financial twins on paper. Harry is terrified of running out of money. The moment he retires at 62, he files for Social Security. Because he claimed it as early as legally possible, his monthly check is permanently reduced to approximately $1,750 per month. He combines that with his pension, lives modestly, and refuses to touch his 401k. He lets it sit untouched, growing year after year. Fast forward 11 years. Harry is now 73. His 401k has ballooned to nearly $900,000. Then the IRS arrives. His forced, required minimum distribution, based on that balance, is enormous. Over $30,000 that year and every year following, regardless of whether he needs it. This stacks on top of his pension and Social Security, pushing him into a significantly higher tax bracket. And because his income spiked, up to 85% of his Social Security benefit, which was already reduced because he claimed it early, becomes fully taxable under IRS rules. Harry hoarded his money to feel safe. His reward is a large, permanent annual tax bill he cannot escape. Sally understands the tax trap, so she applies the bridge strategy. When she retires at 62, she turns on her pension, but ignores Social Security entirely. She begins drawing from her 401k to pay her living expenses. Because she has no Social Security income yet, she sits in a very low tax bracket. She pays taxes on her 401k withdrawals at a significantly discounted rate. For 8 years, Sally systematically spends down her 401k. By the time she turns 70, her account balance is considerably smaller. But here is where the strategy pays off completely. At age 70, Sally activates her Social Security benefit. Because she waited and allowed it to grow at the guaranteed 8% annual rate, her monthly check is not the $1,750 that Harry receives. Her benefit is well over $3,000 per month, guaranteed for the rest of her life. When Sally turns 73 and the IRS comes asking for required minimum distributions, her forced withdrawal is small. It barely affects her tax return because she already spent down the majority of her 401k during her 60s at discounted tax rates. Harry ends up with a smaller guaranteed monthly income, a massive ongoing tax problem, and ongoing anxiety about outliving his savings. Sally built a large, reliable stream of guaranteed lifetime income. She paid her taxes when the rates were low, completely diffused the tax torpedo, and never has to worry about running out of money because her Social Security benefit alone is now substantial. This strategy is not right for everyone, and it is important to be honest about the exceptions. The entire bridge strategy depends on delaying Social Security until age 70 to maximize lifetime income. If you have serious health conditions or a family history of shorter life expectancy, delaying simply does not make financial sense. In that case, claiming Social Security earlier is absolutely the right move, so you can actually receive and enjoy the benefits you paid into throughout your working life. If your 401k balance is relatively small, it cannot realistically serve as an 8-year bridge. If drawing from it to cover all living expenses from 62 to 70 would drain it entirely, that is not the right path. You always want to maintain a meaningful financial cushion for unexpected costs. A major home repair, an unplanned medical bill, or any other emergency. Emptying your account entirely defeats the purpose. If you are in your late 60s and still earning a meaningful paycheck, you are already in a higher tax bracket. Pulling additional money out of your 401k on top of that earned income would simply create a large, unnecessary tax bill right now. The bridge strategy only works effectively when your income is naturally low during the transitional years. When one spouse passes away, the surviving spouse retains the larger of the two Social Security checks, and the smaller benefit disappears. If you are the higher earner in your marriage, delaying your Social Security to age 70 is not just a personal financial decision. It is a decision that permanently protects your partner. By locking in the maximum monthly benefit, you guarantee they will have the highest possible income to rely on if you are the first to go. It is one of the most impactful financial decisions a married person can make for their spouse's future security. Always evaluate your own specific situation, your health, your account balances, your household income, and your family circumstances before committing to any particular strategy.